For the first time in over a decade, these two lines are diverging from one another, and it shows us exactly what is wrong with today's economy. The blue line is the United States inflation rate, and the black line is an index of the price of key commodities, things like oil, wheat, natural gas, soybeans, coffee. The price of these commodities remains on average 50% higher than they were before the pandemic started. The rate of inflation in the US, however, has supposedly come back down to 3%, roughly in the range it was before 2020. So on the one hand, government data tells us that inflation has cooled down to very reasonable levels. On the other, we clearly see that prices of key raw materials that make up the goods and services around us are still markedly higher than they were before the pandemic. Milk that cost roughly $3 a gallon before the pandemic is now at $4, 30% higher. A dozen eggs that cost $1.50 in 2020 now costs roughly $4 today, 200% higher. This is not just everyday items. The average price of a new car was $37,000 before the pandemic. Now it's $49,000. The average price of a home was $320,000, and now it's $420,000. The rate of inflation that you see here is a yearly change of consumer prices, but it does not reflect the real problem that we have today, that prices are still too high. But what people are most worried about is that these prices could still accelerate higher from here once again. The yearly rate of inflation seems to be staying stuck at 3%. Back in 1971, for example, we saw something quite similar. The US also saw a large inflation spike, which it did cool down, but then it stopped cooling down. Inflation stayed stuck at 3% and began to pick up once again, leading to one of the most catastrophic waves of inflation ever recorded. And this is where things really got crazy. Between 1971 and 1982, the price of a home went from $20,000 to $70,000, more than tripling. The price of gasoline at the pump went from 30 cents a gallon to $1.20, effectively quadrupling the price of energy. The world's most widely recognized inflation hedge, gold, has more than doubled in price just over the last 2 years. If we zoom out a little bit, we see that this is what gold was also doing in 1971. In fact, if we overlay the inflation rate on top, we see gold moved higher right before inflation turned up from 3% and began to make its way up to 15%. Many again point to gold's price surge today as evidence for why inflation should turn up once again. Indeed, the numbers from the most recent inflation report suggest that the price of bananas has gone up by 7% just over the last year, beef and veal by 14.7%, and the price of coffee by 18.9%. Now, these price increases have likely been influenced by tariffs in a significant way. But the question remains, if all of these everyday items have gone up by double-digit percentage points in the last year, how on earth is the inflation rate in the US supposed to be at just 3%? Well, we can answer that by decomposing the consumer price index into its different components. We do see the impact of tariffs in the goods section of the CPI right here, as they've gone from being a non-existent portion of inflation in early 2025 to now officially contributing to higher inflation and explaining at least part of why inflation has jumped up in the last few prints. But what we also see from this decomposition is that the goods section of the consumer price index is relatively small in proportion to the overall inflation rate, and it rarely represents a very significant part of inflation. The largest component of the CPI is shelter, and it would make sense that it is. In fact, shelter inflation is still contributing to a good chunk of inflation in the US in the present day, and is clearly what has kept inflation at elevated levels over the last 3 years, and could very much cause it to turn back up once again. But if we look a little bit closer, you'll notice that the most recent contributions to the shelter component had actually gotten a lot smaller than what they were back in 2023, for example. The reason for this can be seen by looking at the inflation-adjusted trend of home prices in the United States. They've been steadily going down over the last couple of years. Now, again, we're still much higher than we were pre-pandemic, but the overall trend is still downwards, which is contributing to a lower rate of inflation. In order for inflation to accelerate from here, we would need to see home prices pick back up once again. And we actually don't believe that's likely to be the case. This is the average mortgage rate in the US that has been shifted forward by a year and a half. interest rates have by far the biggest influence on the price of homes. As you can see, when mortgage rates rise, home prices tend to struggle in the next year and a half. And when mortgage rates fall, which allows a lot of people to buy homes, well, prices boom over the next year and a half. This is even more clear when we flip around mortgage rates. These two lines pretty much become a mirror image of one another. And today it does tell us that home prices should continue to struggle until at the very least early 2027. Shelter inflation will likely only really pick up when mortgage rates begin to fall, and that has not happened yet. If you want to learn more about the markets or simply make the most out of these current financial situations, then head on over to SandstoneFX and open up an account. We are currently running a holiday promotional bonus for all of our new members before the end of the year.